Hey guys, welcome back. Jeb here. In today's video, we're going to talk about affordability because that seems to be one of the biggest questions that home buyers have in this market is when will we see home prices pull back? How can they continue to rise at this pace? It's unaffordable, right? Well, it is, but let's talk about some basic economics before we get into the idea of affordability. And then we're going to take a look at some of the common questions that you guys ask when it comes to affordability. And that is, who can afford these properties? How much income do you have to make to be able to afford a house in this market? We're actually going to look at some California statistics that was just released by the California Association of Realtors. We're going to take a look at a couple of different counties here in California as well, so you can see what the average income is in those markets to get at an idea of how people are affording homes there. But we're also going to talk about how that translates outside of California in other states across the United States, to give you an idea of what you will likely expect over the next year or so with regards to home prices. So, a lot of people look at home prices and just merely from the way that they've risen over the last year and a half, they look at it and say that, it's unsustainable, right? Because you're getting growth at 15 to 20% in some markets. How can people continue to afford this? And honestly, it's something that I think about quite often as well, because, at some point there has to be some relief, right? At some point you maximize the number of buyers that are able to purchase at these levels, and then home prices crash. No, not necessarily. Home prices will probably moderate at that time, but let's take a minute and talk about what's driving the market, right? We've talked about this many times, and it's supply and demand, right? And until something changes with supply and or interest rates, because interest rates is a key driver in that buyer demand, until one of those two things change, you're likely not going to see a change in the housing market unless affordability comes into play. And that's what we're going to talk about here in just a moment. So right now we've seen, very low supply really coming out of, when the market started to rise back in 2012. So at the beginning of the housing pandemic in 2020, we were already coming into that year with a low supply of homes. During that time, you had, interest rates, somewhere in the mid 3% range. And when the pandemic happened, the Fed lowered the Fed funds rate, which impacted interest rates. Interest rates shot down to the mid 2% range for a lot of 2020, which gave buyers the ability to purchase more home at that time, right? Because interest rates dropped, they can now afford to purchase more home. At the same time, you had a lot of things playing into the market during 2020. You had people being able to work from home. You had people wanting to move out of the state because now they could work remotely. So they no longer wanted to, stay in high cost areas. They wanted to go somewhere where they could purchase a property. You had baby boomers staying in property, aging in place. At the same time, you had millennials coming into the market, right? The largest pool of home buyers to ever enter the market starting buying property. So you have all of these factors playing into to the home buying process, along with, construction really slowing and almost to a halt in a lot of areas because of pandemic, because of workers, and because of the lack of lumber and building materials and all of these things. So all of those things more or less added to the already low supply of homes. And then you throw in, the interest rates, and you really have this perfect storm, if you will, right? So people are overbidding on properties. They're, multiple offer situations. People are going above and beyond the asking price, waiving contingencies, doing all of these crazy things in order to get into a property. And in month over month, we're seeing appreciation in most markets across the United States. And that will likely continue until we see a change, right? And it either has to be a change in interest rates, which isn't really likely to happen until sometime in late 2023, 2024, you might start to see interest rates rise, and or a huge supply of inventory come to the market at one time. Now, keep in mind, any inventory that comes to the market that would be potentially priced below fair market value in most areas would probably get purchased up pretty quickly by home buyers, by those home buyers that have been, in multiple offer situations and bidding on property. You have those buyers. And you also have investors out there, right? Investors looking for, some stabilization in their returns and what have you. And investors are looking to buy property. So you really have, the demand isn't going anywhere, right? So with low interest rates, demand's going to stay high. You're not likely to see a huge supply of homes come to the market. But if you do, they're likely to get purchased pretty quickly because of the demand. And so that brings us to affordability, right? What happens with affordability? Because, at some point, as home prices continue to rise month over month over month, you start to wonder who can afford these homes? How many people are left to be able to purchase at these prices? And that's really what I struggle with. It's not that I expect a huge decline in the market. It's at some point, you're going to run out of buyers. But when does that happen, right? What kind of incomes are we looking at here for these buyers? And the one thing that nobody factors in on the affordability idea is down payments, right? How much down payment are these buyers coming in? Yes, home prices are rising. Yes, there is a limited supply of buyers at some point, but if they're putting in large down payments on these properties and their monthly payment is still reasonable in their eyes because of low interest rates, that coupled with the number of home buyers that are bidding against each other on these properties tells me that you're likely to see, a market like the one we've experienced over the last year. You're likely to see that a similar market for at least another year because, demand is not likely to slow during that time. But, that's what's really difficult to break down because we don't know. We don't know how much money people have for down payments, right? We know that, 2020 allowed savings to grow more than they've ever grown historically. So people have more money than they've ever had. Are they using that for their down payments? It's hard to say, right? Because we don't know. But at the same time, we do know that people that owned homes in 2020 gained a lot in appreciation. And a lot of those people that are buying in this market are those people that owned homes, right? They're selling their properties and they're buying something else. So it's not just, first-time home buyers entering the market. You have a large pool of buyers that are move-up buyers that owned property. They gained a lot of equity during 2020, and now they're able to purchase something, use that down payment, and buy something else. So the affordability question is a difficult one to answer because we don't really know where the money's coming from, how much they have to put down. But at some point, I do believe if home prices continue to rise, you've got to see some sort of pullback in the market, right? We can't continue to have, 4 or 5% appreciation month over month over month. It's not sustainable. I do know that. I just don't know where's the breaking point. And I do believe at the same time, when you start to run out of buyers, you're not necessarily going to see this huge decline in prices, right? You're probably going to see a moderation in prices. Prices could pull back a little bit, but I don't think you're likely to see a huge decline in the market. These 20-30% that people are talking about. I think if anything, you'll see small pullbacks in the market, and that'll give people an opportunity to get in. It will also, allow supply to build, right? If people back off the market or demand slows at all, you're likely to see that supply build. And if you have more homes to choose from, you're going to see a couple of things. You're going to see, home buyers not necessarily having to overbid on property, but you're also going to see, more property continue to come to the market because there's a lot of people sitting on the sidelines right now wanting to purchase property. And they look out there and they look at the inventory and they're not ready to sell their house or put their house on the market because they're not seeing homes that fit what they want. So as they start to see homes that, are closer to what they want to purchase, you're going to see their homes come on the market, and that's going to help inventory build. Now, the other side of this is people in California, where home prices have accelerated and home prices are higher than most places in the country, a lot of these people are able to take their incomes from California and purchase in other areas across the United States. And that's been one of the key drivers in other markets across the U.S. is people leaving high-cost areas and moving out to, the Austin, Texas, Phoenix, Arizona, Boise, Idaho, because they're able to, take their California income in a lot of ways because now they're able to work remotely. Some just took the appreciation that they gained in their property and went and bought houses cash. But either way, they're able to take that money that they've gained in California in one way or another and go to other states and buy property. And that's what's caused, this frenzy in other markets as well. And as long as you have people leaving California, which you're going to because of political reasons and taxes and all that good stuff, you're likely going to see that appreciation in those markets as well. But let's take a look at affordability in the state of California, right? This is a report that just came out from the California Association of Realtors. Talks about, different counties, talks about the average income that you need to afford these properties. A lot of you guys ask those questions. How much money do you need to be able to buy one of these homes? Let's take a look at that report here and gives you a pretty good idea of what is going on. It doesn't talk about down payments, but you also have to understand that, when you start getting to these higher price points, clearly you've got to, not only do you need the income, you've got to have the down payment in order to make it affordable. So 27% of California households could afford to purchase the $720,000 median priced home in the first quarter of 2021, down from 35% in the first quarter of 2020. So year over year, you've dropped 8% in affordability, the percentage of Californian households that could actually afford to purchase at that median price of $720. A minimal annual income of $131,200 was needed to make monthly payments of $3,280, including principal, interest, and taxes on a 30-year fixed rate mortgage at 3%, right? So take that into account there. If interest rates go down, you're going to have, more people in theory be able to afford these prices. If interest rates go up, less people are going to be able to afford at these prices. 40% of home buyers were able to purchase the $535,000 median price condo or townhome. An annual income of $97,600 was required to make a monthly payment of $2,440. So for condos, average price is $535,000, or the median price is $535,000. You need an average income of somewhere around $97,600 to be able to afford that payment. Now, here's the caveat. You don't know what kind of debt loads people carry at those incomes, right? We're just talking incomes here. We're not talking anything else. So housing affordability in California remained at the lowest level since mid-2018 as higher home prices fueled by a shortage of homes for sale pushed the state's median home price more than 22% higher on a year-over-year basis. So median home price went up 22% on a year-over-year basis, resulting in an 8 percentage point decline in the housing affordability index in the first quarter, which we mentioned a moment ago. So California Association of Realtor Home Price Index measures the percentage of all households that can afford to purchase a median price single-family home in California. CAR, California Association of Realtors, also reports affordability indices for regions and select counties within the state. The index is considered the most fundamental measure of housing well-being for home buyers in the state. Now, again, I've highlighted a lot of stuff here. I will leave a link below for those of you who want to read the entire article. Compared with California, more than half of the nation's households, 54%, could afford to purchase a $319,200 median priced home. So the nation's median price, $319,200, which required a minimal annual income of $58,000 to make a monthly payment of $1,450. Nationwide affordability also fell from 59% a year ago. So fell from 59 to 54% with home prices rising here. You need an average income of $58,000 to be able to make that $1,450 monthly payment. Now, keep in mind, you got those California incomes, as I mentioned, that California appreciation money moving into these markets. You've got way more people that can afford to purchase these properties than just the people that live in those areas at the moment. And that's why people are pushing those home prices up in a lot of these areas. Affordability fell from a year ago in all Southern California counties, with Orange County being the least affordable, 20%. So I'm in Orange County, the least affordable in Southern California, and San Bernardino County being the most affordable. So any of you that are local, you know that a lot of people are transitioning out of Orange County into Riverside, San Bernardino County, because home prices are less. It's more affordable. And what's happening there is home prices there are rising at a rapid pace because, again, you have all of these people leaving this area, fleeing there where, it's more affordable for the time being. How long will that last? That's hard to say. In the Central Coast region, Santa Barbara County was the least affordable at 14%. During the first quarter of 2021, Lassen remained the most affordable county in the state, followed by Kings. The minimum qualifying income was less than $64,000 for each of these counties. Lassen also had the lowest minimal qualifying annual income to purchase a home at $45,200. Mono is the least affordable in the state at 3%, with Santa Barbara at 14%, Monterey at 17%. So each of these counties requiring at least an annual income of $157,600 to purchase a median priced home in the county. San Mateo remained the least affordable county in the state and required the highest minimal qualifying income of $337,200 in the first quarter of 2021. It was the only county in California that had a minimum qualifying annual income of over $300,000. Talking about median home price, monthly payment, and income that you need. So Los Angeles, last year it was at 31%. So you can see, the affordability is clearly falling here. The median price in that market is $682,360. That works out to a mortgage payment of $3,110. You need an annual income of $124,400. Orange County, affordability has gone down, but not a lot since last year. And Orange County has fallen from 24% to 20% since last year. Average median home price $1 million. Equates to a payment of $45,660, and you need an annual income of $182,400. You can see the rest of the counties here. This goes through all of California. If you're interested in that, you can check it out. You can check out the link below. But the question comes down to, how long can this continue? Well, it will continue until you run out of home buyers at those prices, right? And as long as you have multiple offers on property, people continuing to outbid one another, things aren't going anywhere unless something happens with interest rates and or supply. And I think we both, know that neither of those are likely to change anytime in the near future. So, the question becomes affordability, right? At some point, affordability will be the problem here as home prices continue to rise, because I don't think you're going to see a change in supply or interest rates in anytime soon. The scary thing to me is watching home prices rise so rapidly, because you're really pricing buyers out of the market, right? The first-time home buyers, the entry-level home buyers are really feeling the most pain here, because those are the properties that are really the most desirable for most people out there, right? There's just a bigger demographic, more demand in those lower price points, which means more competition, and those home prices are rising rapidly. And to me, that is the scary part is how first-time home buyers are going to be able to enter the market, as prices continue to rise. It's one of those things that it's difficult to answer, and I don't think any of us have the answers. But I just want to bring it to your attention out there that the one factor that I see playing most into this market is the affordability, more so than anything else anyone is talking about. But as I always do, I'll continue to update you as more information comes out on this. If you have questions for me, comments for me, do me a favor, leave them below. But for now, I appreciate you taking the time to watch. Appreciate the support. Hope to see you again soon. Have a great day. Bye-bye.